This is the Asia Trade. I'm Paul Allen in Sydney.
I'm Haidi Stroud-Watts. The top stories this hour. A week lead-in for Asia as US stocks slip from record highs, with traders hitting pause ahead of key earnings reports, including Tesla and Boeing. Hyundai India shares set to start trading today, with a hefty price tag leaving retail investors on the sidelines. And we are live at the Singapore International Energy Week to discuss the impact of China's slowdown. Woodside CEO Meg O'Neill is with us.
And we've just opened for trade here in Australia. Always hard to get a read on things in the early going with the staggered open, but the ASX just off by a few points at the moment. We'll see if we can build on the gains that we saw on Monday. Gold miners had an excellent day in Australia yesterday, but we've seen the gold price retreating off its record highs. Also worth keeping an eye on the iron ore majors in the materials space. We heard from Rio Tinto's iron ore chief Simon Trott a little bit earlier on, saying that China is at a structural peak in terms of steel demand. A bit earlier also we had PPI numbers out of South Korea. Producer prices in September accelerating 1%, a little bit slower than the 1.6% that we saw in August. And in terms of Nikkei futures, setting up for some modest gains after a rather flat day in Japan yesterday. The yen still looking pretty weak. We got the Chinese yuan, meanwhile, 7.1370, Heidi.
Paul, let's take a look at how US futures are shaping up at the moment. It was a challenging session. The S&P 500 rally taking a break near technically overbought levels there, so falling from a record as earnings. That momentum is really set to pick up. As we mentioned at the top, Tesla and Boeing are the ones that we're watching at the moment. When it comes to futures, they're pretty much unchanged at the moment. NASDAQ futures also not seeing much of a move, and we're watching oil markets as well, of course, given these ongoing geopolitical tensions. Israel planning its next move on Iran after the weekend's attack. We're also, of course, keenly watching communications from the Fed. We're hearing now from San Francisco Fed President Mary Daly speaking at a Wall Street Journal tech event, saying the reasonable estimate for the neutral rate is between 2.5% to 3%. Her own estimate for that is closer to 3%. Also talking about the state of the US consumer. They're trading down, showing limited pricing power. And of course, so much of that question mark has been the perhaps unusual strength that we've seen in the US consumer in recent data points. They have to adjust policy rate as inflation falls. Mary Daly also saying they don't want to see the labour market deteriorating any further, and that monetary policy is absolutely still tight. Interesting context given, of course, some of the concerns that perhaps the Fed made a policy misstep by going 50 basis points at a time when most of those data points are still coming in surprisingly better than expectations, but that she hasn't seen any reason to stop cutting rates. Now, we have also been, of course, watching all types of Fed speak given this ongoing rate-cutting cycle debate. We heard from the Minneapolis Fed President Neel Kashkari about his view on how this rest of the cycle should play out.
For me, to move quicker on the dots would be if we saw a weakening, like real evidence that the labor market is weakening quickly, then that would tell me, as one policymaker, hey, maybe we ought to bring down our interest rate more quickly than I currently expect. Right now, I forecasted some more modest cuts over the next several quarters to get to something around neutral, but it's going to depend on the data.
Well, let's bring in Jim Caron, now CIO for Cross-Asset Solutions at Morgan Stanley Investment Management. And Jim, we just heard from Neel Kashkari there, Fed's Mary Daly also speaking at the moment. Seems to be a little bit of caution around the idea of the future pace of rate increases. I'm interested in getting your opinion on it and whether or not you see there's a chance that we don't get any move at all in November.
Yeah, thank you for having me on your show, and good morning. Look, I mean, everybody's talking about rate cuts right now, and it is a question of the pace. So the path is not in question. The Fed is moving policy lower. It's really just a question of what's the dance that we play with inflation. So the reality is that inflation has come down. It is stable. But as Neel Kashkari was just mentioning, if you start to get a significant rise in the unemployment rate, and that's the key, then it would warrant the Fed to start cutting interest rates more and faster. I think the Fed taking 100 basis points from their peak policy rate at 5.5%, bringing policy rates down to 4.5%, I think is perfectly reasonable over the very, very near term. So I do think that they cut rates in November, 25 basis points. I think they cut rates another 25 basis points in December. It's still a reasonable policy rate, but the idea of this whole thing is that we don't want policy rate to come down too much and stoke the inflation pressures. It's really going to be dependent on the labor market situation.
Well, let's talk a little bit more about the inflation risks as well, because we've got an election coming up. One candidate's favourite word in the dictionary is tariffs. Do you think there is a risk that we could see inflation come back in 2025 if we see a lot of hefty tariffs on imports?
Yeah, let me preface this by saying that I think that we are in an inflationary environment. I don't think, no matter which candidate comes in, whether it's Donald Trump or Kamala Harris, I think we're going to be in an inflationary situation. Now, when we think about tariffs, I mean, clearly, if you used all the tariffs, if you took former President Trump at his word and he placed all those tariffs in, certainly you're going to get higher inflation. But the other thing is that tariffs are a tax, and the other thing that's a tax are taxes. Don't forget that Vice President Harris is also talking about potentially higher taxes too, which is also inflationary. Now, if you ask both parties, the way that they are going to get this is through higher productive growth, and that effectively this inflation will not be as big of a problem because you're going to get this you're going to get growth through higher productivity. Personally, the way that I'm investing and the way that I see things is that we are in a higher inflationary environment. It doesn't really matter to me which it is. Clearly, if we take tariffs at its word, yes, there's a mechanical, mathematical conclusion that you could get higher taxes. But also remember, though, that Donald Trump's philosophy really surrounds the S&P 500. So if his tariff policies end up creating a lot of inflation and bring down the equity markets, I think he'll stop. I don't think he has an ideology around it. I think that he's going to measure himself by how the markets are doing. So in that sense, I think he is in check a little bit.
And of course, we've seen the reaction to, upside surprise after upside surprise of positive data from the US play out when it comes to bond markets, right? And that kind of takes us to our question of the day from the MLive blog, which asks how long will it take before the 10-year yield hits 5%? We've already put on, about 40 basis points over the past month. Do you think that this is sort of a one-way trajectory given the direction of the data, the fact that we're hearing Fed officials sound more cautious, and there's a lot of debate over whether they, might have misstepped by going 50?
So for me, it's a question of the slope of the yield curve, right? So, and also the terminal rate for Fed funds. So where do we think the terminal rate is? Where do we think the Fed ends their rate cutting policy? And I would argue that it's probably somewhere around 3.75% to 4%. Now, I'm higher than most people. Most people would argue that it's a lower rate. I know the markets are pricing in that it's a lower rate. But given the fact that inflation, I think, is going to be stubborn to come down, and also the yield curve is likely to steepen. So let's say, for example, if we look at the Fed funds policy rate to the 10-year yield and we take that spread, we take that differential, that on average is about 75 basis points. So let's say the Fed goes to 3.75%, that's their terminal policy rate, that's where they cut policy rates to, then that means the 10-year note could go to 4.5%. And I think that's very, very possible. But if the Fed only can cut rates to 4.5%, then the 10-year note can go to 5%, and certainly. So it's really a question of where we think that terminal policy rate is and how much the yield curve is going to discount that inflation. So I don't think that a number like 5% is uncharacteristic. It really just depends on where you think the Fed can cut policy rates to.
Jim, I wanted to get your views on China because I thought the bull in a candy shop, at least for now, is a really compelling way to look at it. But in the medium term, in the longer term, do you have that conviction that what we see as, largely monetary side easing is going to translate into meaningful, longer term demand?
This is a great question. Thank you for asking it. So I think that many Westerners look at China and policies from the central bank through the lens of a Western eye. And typically what they say is, okay, is there going to be stimulus? Okay, yes, there's stimulus. And then the next question is it enough? Is it enough to solve all of the problems that are plaguing China? And I think that, yes, those are all good questions. But the real question is how much does that stimulus translate into easing financial conditions such that it creates a durable increase in demand? What China's lacking right now is demand, internal demand, in terms of consumption, consumers, and getting their population to start to think about, moving into markets and investing. And just because the stock market goes up in China, and just because it's, off of a catalyst of stimulus, doesn't necessarily mean that that's going to translate into durable, real demand. The way that it works, particularly in the U.S. and in Europe, is that if you lower bond yields, if you get the equity markets higher, you ease financial conditions, people start to invest. When they invest, companies get stronger, jobs get created, people make more money, and they all of a sudden start to spend, and that boosts GDP. That transmission mechanism doesn't work as well in China, primarily because most of the wealth, most of the ownership of assets is primarily in the housing market. So the equity markets going up don't necessarily translate into that easing of financial conditions and durable demand for consumption. So it's the right question to ask. Is China adding stimulus? Yes, the answer is yes. Are they adding enough? Well, we can debate that. But I think the real question is will it translate into real consumer demand? And that's what we're not seeing right now. So it makes me somewhat skeptical that the policies are being as effective as they possibly could be. I think that they're being held back a little bit because of this.
All right, Jim Caron, CIO for Cross Asset Solutions at Morgan Stanley Investment Management. Thanks so much for joining us today. Just want to check in on the BHP share price at the moment. It's retreating a little bit in Sydney right now, off of 0.5%. We have had the start of the class action against BHP about the Samarco dam collapse way back in 2015 in Brazil. That event, of course, leaving 19 people dead, thousands homeless, water contaminated. This is a huge class action which has been being brought against BHP by 620,000 Brazilian clients seeking reparations of up to $70 billion. So day one of the trial getting underway, Haidi, BHP being accused of being driven by a relentless pursuit of profits and cynically and doggedly shirking responsibility for that dam collapse. So opening statements there and what's going to be a very closely watched trial.
Yeah, closely watched as we continue to see just such an interesting time for the big miners, right, in light of the China story as well. But also coming up on the Asia Trade, we'll be talking about Hyundai India's IPO with Dunne Insights. Woodside Energy CEO Meg O'Neill will be along with us to talk about the LNG market outlook from Singapore International Energy Week. Plus, as King Charles tours Australia, the country's Republican movement tells us why the royal visit may revive a push to move away from the monarchy. Much more ahead. This is Bloomberg. Take a look at the picture when it comes to oil. We are seeing some gains this week after losing more than 8% last week. China moving again to bolster the economy with easing through its banks, and traders, of course, continuing to track the risks that's passed on to the supply outlook with these ongoing tensions in the Middle East. Well, US officials are in the region in an attempt to engineer a ceasefire between Israel and Iran-backed Hezbollah and Hamas. Bloomberg's Michael Heath joins us now. Michael, these talks continuing even as we know retaliation against other proxies in Iran are still very much being discussed.
Yeah, I mean it's Secretary Blinken's 11th trip out there since the first attack. So he's trodden this route before, but it is I guess to some extent different this time in the sense that the head of Hamas has been killed. Israel has had such success in terms of tackling the leadership of, or taking out the leadership of Hezbollah and degrading its forces. So, I mean, there might be some prospects there, but the other issue, of course, is they're still to retaliate on Iran, which could then throw us into a new phase of escalation as well. And there are reports out there that the US missile defence system that they were deploying to Israel is now sort of basically in place and set up. So at any time that response could now happen. The other interesting thing too, is that Blinken, not only is he trying to look for a ceasefire, he's also trying to put forward some form of day after plan, which is also very interesting. There's no details on that whatsoever. But yeah, I mean, I think this is really worth watching, because we could be at a bit of a point here.
Is Israel showing any signs of interest in a ceasefire deal? I mean, you mentioned the possible retaliation against Iran is very much still on the table. What about activities in Gaza and on the northern border?
Yeah, I mean, look, Bloomberg has a report that, citing an unidentified official, that they are interested in looking at a way to bring the hostages home, to allow more aid in, and to bring the fighting sort of to a close. But there's also a bit of disunity among the various factions within the government too on what they're actually wanting to do. I mean, the latest thing is they've been striking the banking facilities of Hezbollah, and the Israeli spokesman said that under a hospital in Beirut, there's $500 million in cash and gold that's used to finance Hezbollah. They're not going to target that, obviously, because it's in such a sensitive position, but they are monitoring it. It's sort of a signal, a warning there. But at this stage, it looks like they're just going to keep trying to degrade those guys, Hezbollah and Hamas. I mean, both sides have said that Hamas and Israel have said they'll keep up the fighting even after the death of Sinwar. So we really, it's just up in the air at this stage.
You mentioned 11 trips now for Antony Blinken. Mostly he's returned empty-handed as he continues to be rebuffed. I do wonder, is there an expectation that, this sort of relationship and negotiation would be different under a different administration, be it a continuation of a Democratic administration or a return of Donald Trump?
Yeah, I mean, I think that's a really good point, Heidi. I mean, we're 2 weeks out from an election. The incentive for Israel to do anything much with the Biden administration would have to be fairly limited. And the possibility that Donald Trump would return to office and basically give Israel a free hand there, as in terms of what it wants to do in the Middle East, would be very enticing to Prime Minister Netanyahu. But either way, I mean, what a Harris administration, should she be elected, would choose to do there, I guess, would be on Israel's mind as well. So in the meantime, it sort of has this window that it can keep exploiting. But given we are so close to a presidential election, this is really the last chance, I think, for Secretary Blinken to secure something.
All right, Bloomberg's Michael Heath there. Another story we're following is China becoming on track to become the largest market for Russia's pipeline gas this year. The country's overtaking Europe after the Kremlin's war against Ukraine capped flows of fuel to the region. Bloomberg calculations indicate Russia's gas giant Gazprom exported 23 billion cubic meters of natural gas to China in the first 9 months of 2024, and that's nearly 40% more on a year ago. Well, BRICS members are gathering in the Russian city of Kazan for their first meeting since the group expanded in January. Much of the focus, though, is on China and India as tensions over a border dispute ease. Bloomberg's Greater China Executive Editor John Liu joins us now. John, what are the chances here of some normalization of relations between China and India?
Well, the chances look better now than they have looked in a very long time. What we've heard so far is from India's top diplomat saying that the Chinese and the Indian governments have reached an agreement to allow patrols to resume on both sides of the border in the Himalayas. That's, of course, where there were clashes between troops from the two countries. We had soldiers die. That precipitated a real downward plunge in relations between the two neighbors, which actually fought a war back in the 60s over the same territory. It seems now that the stage is set for some return to normalcy in that relationship. Heading into the BRICS, the thing that everybody's going to be watching for is if Xi Jinping and Prime Minister Modi are going to have a one-on-one bilateral meeting at that event.
If we do see a warming of that relationship between China and India, what are the broader geopolitical implications, particularly as we're just 2 weeks out from a US election now?
I think they could be quite substantial. Of course, we're still a little bit shy on details at the moment. We don't know if Prime Minister Modi and President Xi will meet, but if that relationship were to strengthen, I think that would undermine to quite a large extent the American effort to try and get India on board as sort of a piece of this containment strategy that's been deployed in Asia. India, of course, is part of the Quad with Australia and Japan and the United States. There has been more tension between the U.S. There have been allegations by both the U.S. and Canada that Indian officials are involved in killings of some separatists in both countries. And of course, the picture of Xi and Modi meeting at a conference hosted by Vladimir Putin is not going to be one that Washington finds very pleasing.
And of course, at this BRICS summit, we're also watching that ongoing relationship and friendship between Beijing and Moscow as well.
That has been a relationship that has brought a lot of tension, not only to the Chinese relationship with Washington and the United States, but also relations with Europe. As Paul mentioned at the start of this, China has become the major market for Russian oil. It has been a supplier of many consumer goods, and as the United States has said on many occasions, China, the U.S. believes, is also the major supplier of dual-use technologies to Russia, so things that could be used for both civilian and military purposes. The U.S. has not been shy of sanctioning Chinese companies that it accuses of providing equipment and technology that have helped the Russian war effort.
Bloomberg executive editor for Greater China, John Liu there. More ahead on the Asia trade. This is Bloomberg.
This is the Asia trade. The latest now from the corporate front. Cheesecake Factory shares jumping after the bell on a report that activist investor JCP has reportedly built a 2% stake. The Wall Street Journal says JCP is urging executives to spin off 3 of the firm's smaller restaurant brands into a separate public company. Bloomberg Intelligence thinks Cheesecake Factory may push back against the plan due to cost duplications.
Disney has named James Gorman as chairman and says it will also appoint a new CEO in early 2026. Gorman is a former CEO of Morgan Stanley and was tapped in August to head Disney's succession planning. Bob Iger returned to the top job in 2022 after the ouster of his successor, Bob Chapek. Iger says he will leave for good this time when his contract expires.
Qualcomm has unveiled a more powerful processor that's designed to bring laptop-level capabilities to smartphones. The shift in design is expected to help mobile devices take advantage of new AI tools. Qualcomm says the new chip will be 45% faster than the previous model and use less energy.
BHP has gone on trial in London over a devastating 2015 dam collapse at a Brazilian iron ore mine. The company is accused of trying to avoid paying billions of dollars of compensation to those affected. The London case will test how far English courts are willing to go to punish firms over environmental disasters that happen far away. More than 620,000 Brazilians are seeking around $47 billion.
The Bank of America chairman and CEO Brian Moynihan is heading to Sydney to mark 60 years since the opening of its first Australian office. And he joins us exclusively tomorrow, 8 a.m. Hong Kong, 8 p.m. in New York. We have more ahead on the Asia trade. This is Bloomberg. We've been up and running here in Australia for about 30 minutes this Tuesday morning, and we're seeing a little bit of weakness on the ASX. The broader index off by about 0.9%. Mining giant BHP, we mentioned a moment ago, facing a major class action lawsuit in the UK. That's off 0.8% as well. But almost every sector on the ASX in negative territory at the moment. We've got Nikkei futures, though, in very modestly positive territory. S&P E-minis, meanwhile, pointing a little bit lower. We have been hearing from the Fed's Mary Daly in the past little while. She says she hasn't seen any information that would suggest we wouldn't continue to reduce the interest rate, Heidi.
We are looking ahead, Paul, to the trading debut for Hyundai Motor India after raising $3.3 billion in the country's biggest ever IPO. The deal was oversubscribed more than 2 times on the last day of the sale, but ultimately drew poor interest when it comes to the retail component. Let's get some perspective now with Michael Dunne, who's the CEO at Dunne Insight. So undoubtedly this is a really big deal, a milestone. Were there aspects of this that were disappointing, though?
A little bit. You know, for the longest time, the auto business has been about who can build the highest quality product at the lowest cost. And Hyundai went into India 30 years ago and essentially proved it out when no other automaker from outside was able to do so. So they won in that regard. But guess what? The game has changed, and now automakers are being asked to move into software and electrification and autonomous driving. And so Hyundai looks at this situation and says, let's take the rewards from that initial investment, bring that $3 billion back in-house so we can invest into the future. When it comes to retail investor, they say, yes, but what about the business in India going forward? It's essentially low-cost manufacturing of a high-quality product, a little bit looking in the rearview mirror, and that's why the response was more muted.
We've hardly seen Hyundai as being the only foreign player that have just tried to make this effort into the Indian market, right? Is there something that kind of we can extrapolate from their success and the other failures?
Well, you know what? Looking forward, India becomes potentially a very important alternative manufacturing base to China. Global automakers are feeling less and less welcome in the People's Republic, and many are now turning back to India and saying, hey, let's look at what Hyundai's done there. Can we also duplicate and set up global manufacturing bases in India for exports worldwide? That's the upside that investors would be looking at who put their money into the Hyundai's operation there.
Michael, we saw a lot of interest in this listing from institutional investors, but retail investors sort of shrugged their shoulders in a way. Why the lack of interest?
Well, it's a well-known secret within the auto industry that India's got a massive potential in terms of number of units sold, but it's also got a reputation for being the place where the cheapest cars on the planet are sold. Average cost of a new car in India is right around $10,000. That does not leave a lot of room for profitability margins, and that's been the case for years and years. So other investors would look at this situation and say, what am I buying if I invest into that Hyundai operation today? It's unclear that profitability would be really tremendous, as opposed to investing in software or autonomous vehicles or other future technologies.
So the Indian market likes cheap cars, but what's the state of demand more broadly for vehicles in India right now?
Well, the Indian consumers' incomes are going up, and Tesla's flirted with coming into India to sell their cars. But you know what? We're just not there yet. Tesla's gone to India 2, 3, 4 times, thinking about putting money in and saying, boy, we don't see the demand for our product, which start at probably $40,000 and up.
Do you see an impact on whatever the result is we get in 2 weeks' time after the US elections when it comes to the state of the auto sector in India in both directions, right? Both for homegrown brands and for international players?
Right. So look for, depending on who wins, I think with a Trump victory, you'd have all the focus on the United States. And if you want to sell into our market, you have to manufacture here. That would be whether you're Chinese or European or Indian or Japanese. Trump would be ultra focused on, in exchange for access to our market, you better manufacture. We're tired of importing your cars. That's a Trump message. On the other hand, if Harris were to win, the Democrats are much more about alliance building, and they'd say, hey, India, hey, Vietnam, how about you guys being our next manufacturing base for our automakers? We'll get together, you'll be the manufacturers, we'll be the market, and we'll work together as allies. So that's India's upside today. That's what they're looking at.
In terms of the Hyundai IPO, to what degree is this a bit of a trailblazer? Does it signal a bit of a shift in India towards foreign companies listing and perhaps away from some of these giant Indian-owned family conglomerates that we've seen?
Definitely, up until now, it's always been, majority is family-owned business in India. But Hyundai is a global company with a great reputation these days. It's winning everywhere across the world with great products. Some people call it the new Toyota, the king of the hill. So if Hyundai puts its, mark, hey, we're confident, we're IPOing in India, and it really went well, that will draw the attention of other companies inside India and also global automakers as well.
Michael, really great to have you with us. Michael Dunne, CEO at Dunne Insights. You can turn to your Bloomberg for more on this. TLIV goes where that commentary and analysis from Bloomberg's team of expert editors is. Taking a look at some of the earnings reports that we're tracking, Europe's biggest software company, SAP, has reported a jump in third-quarter cloud sales as it works to move customers to its AI tools and analytics. Cloud revenue rose to nearly $5 billion, marking a 25% increase from a year earlier. Its cloud backlog rose to over $16 billion, reflecting sales to be booked over the next 12 months.
Ping An says profit jumped 36% for the first 9 months of the year as a stock market rally bolstered investment returns. Operating profit was up 5.5% at China's second largest insurer by market value, while new business value growth quickened to 34%. Analysts expect strong profit increases at China's listed insurers after Beijing's stimulus barrage boosted stocks. The report shows that Japan's bankruptcies topped 5,000 cases for the first time in a decade between April and September. After 3 decades of the BOJ's ultra-loose monetary policy, even small hikes could fuel an increase in the number of zombie companies tipped into insolvency. So for more on this, Bloomberg's Caron Lee joins us. Caron, what are zombie companies in Japan? How many are there?
Yeah, well, this is a really interesting phenomenon that we're watching in Japan, and these are companies that struggle to pay interest on debt from operating profit alone. And like you said, Paul, they're really plentiful in Japan. They are 14% of listed companies, so take a second to take that in. And they're concentrated in sectors where the labor shortage is in short supply, including restaurants, hotels, tourism. And this is important because obviously a zombie company can't maintain employment, it can't maintain competitiveness, and it does impact investment. It makes investment difficult. So this is something that people are looking really closely at, especially with all the attention on what the BOJ is doing.
And in terms of what the BOJ is doing, if obviously the tightening cycle continues, what does that mean for potentially these, further instances of zombie companies?
Yeah, well, like Paul said, even a small hike could stand to create more zombie companies. But let's look at what the BOJ is doing. They're not really in a hurry to raise rates. They left the rate where it was last month, and they expect as high as 0.5% between January and March, according to analysts we spoke to. So that's the highest since the early 90s. This is something we're going to be watching really closely from the employment side and from the investment side as well.
Bloomberg's Caron Lee here in Sydney. We do have much more ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching across commodity markets, and oil continuing to really oscillate on the back of these concerns over China's stimulus. Of course, that created a little bit of a boost, but these worries over what's going on in the Middle East, the potential next step of the reprisal against Iran by Israel. We are seeing a steadying trade at the moment, pretty flat when it comes to New York crude. This is a market, of course, that dropped about 8% last week and then surged 2% on the Monday session as well. So at the moment, we are seeing a little bit more of a risk-off tone there. Also watching iron ore, we've seen metals broadly dropping on the back of a stronger dollar there. Traders there are also weighing the assistance and stimulus when it comes to China lending as well, with Chinese banks reducing lending rates by more than expected. But ultimately, that currency effect, the demand for dollar-denominated metals, seeing some pressure there for iron ore, down by just about 1% at the moment. And when it comes to that sort of growth, China growth proxy in particular for copper, we're seeing downside of about 0.7%. Also a big earnings week for miners, but copper in particular, with the Freeport copper output being eyed, especially, Paul.
Indian Finance Minister Nirmala Sitharaman says digital financial services should be used to ensure even the smallest of Indian businesses are connected to the global market. She spoke to the Economic Club of New York about India's economic reforms and the importance of financial integration.
the emphasis has been to make sure there is enough buzz in the economy. We wanted to achieve financial inclusion since the last 10 years, meaning since 2014 when the Prime Minister took office. This is his third term post-2024 June elections. So the financial inclusion step, which was so digitally driven, has given us the lead advantage in the recovery also post-2020. The recovery was largely on the back of public finance, meaning public-funded capital expenditure, building infrastructure, making sure that money goes down directly immediately after COVID to make sure the large, much-awaited infrastructure programs are undertaken and completed in time. So the money, public money going for capital expenditure has been a great fountainhead of the multiplier effect which you want in an economy. The multiplier it was which helped us to sustain growth since after COVID. But sustained growth since after COVID only on public expenditure on capital goods? No, it's also because since 2014, as though he knew that you may have a contingency like the COVID, there was a massive drive to bring every Indian to hold a bank account. And that was given with an identity which is digitally made available. So you have 1 billion bank accounts, 1 billion identity through Aadhaar, which is a digitally driven, biometric, authenticated identity for every person there, Indian, who's living in India. And thirdly, because you were able to identify him, authenticate his existence, and that there's no duplication, you were able to extend credit facility to him, however small or big. Because of this financial inclusion, digitally driven financial inclusion, and making sure that no Indian is left out without financial access, we were able to take the relief giving during COVID through digital direct benefit transfers, without having to post checks to people, without having to tell them, wait for the day when I can reach you. It was spot on. With one button, everybody received the relief that they needed during COVID. So this digital thing didn't stop with financial alone. It was used for medical treatments. It was also during vaccination time, during COVID. Identity of who received which dose, and is this the first dose or the second, was possible. Innumerable ways in which the digital access has helped Indians for themselves to access the global market. We also created an open network for digital commerce, again publicly funded. It was an open access platform through which any Indian producing small things anywhere in the corner of the country can use this platform and access the global market. So the long and short of what I want to tell you is, for the multiplier, government spending money through capital expenditure, and for the small man, having given the access through digital network, he was able to buy and sell using this platform suddenly to the global market rather than his village market alone. All this has simultaneously helped us. So digitizing Indian economy has allowed us to formalize the economy, bring more people onto the formal transactions, which were earlier outside of the GDP calculation.
Indian Finance Minister Sitharaman there speaking to the Economic Club of New York. You can watch us live and catch up on those past interviews on our interactive TV function. That's at TV Go. You can also dive into any of the securities or the Bloomberg functions we talk about, plus become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Do check it out. That's at TV Go. This is Bloomberg.
Time for morning calls ahead of the Asia trading day. Goldman Sachs strategists say the decade of outsized gains on the S&P 500 is over. They say the Wall Street stocks benchmark will likely now trail Treasury bonds and even potentially lag behind inflation. Goldman expects an annual nominal return of just over 3% over the coming 10 years, and that compares with 13% in the past decade and a long-term average of 11%. Heidi.
As for the Fed, Paulo believes chances of a hold in November are rising as the US economy powers ahead. Their chief economist, Torsten Slok, says he sees plenty of reasons for that strength and notes that the bottom line is that the expansion continues. He sees the US remaining on a no-landing trajectory where the economy keeps growing and inflation reignites. Swaps markets at the moment currently pricing less than a 25 basis point cut for November. Take a look at what we're watching when it comes to Australian and New Zealand bonds at the moment. And this, of course, as we continue to really focus very closely on what the Fed speakers are saying at the moment, given the ongoing debate over whether or not that 50 basis point cut might have been a little bit too soon, too fast. We're seeing that decline for Australia and New Zealand bonds, really extending that global debt sell-off there as well. Traders pricing in really a slower pace of monetary policy easing across major economies. Most keenly watching the Fed, of course, given that string of data has consistently coming in higher than expected.
Some of Australia's big institutional investors are looking to the local private debt market for growth, taking advantage of elevated rates at lower risk. Let's cross to Melbourne and our Australian pensions reporter, Amy Bainbridge. Amy, give us an idea of how big this market's getting.
Hi, Paul. Yes, domestically, the Reserve Bank of Australia puts the private credit market at around $40 billion at the moment, with some caveats, however. Some estimates put it at far higher than that. What we do know is that it's a very fast-growing area of interest for our almost $4 trillion pensions industry, which is looking for the next place for returns after enjoying a pretty strong rally on stock markets over the past year or so. And we've been speaking to some of the biggest institutional investors in Australia who are looking to increase their allocations to private credit, both here in Australia and overseas.
What about pension funds sort of more broadly? Is there sort of a clear direction when it comes to plans for private credit?
Heidi, it is a bit of a mixed picture. I will tell you the latest industry data shows it's still less than 1% of money invested in that huge industry here allocated to private credit. Over the last 6 months, I've spoken to a lot of different pension funds. Some say that they're looking to double their allocation to private credit in the next couple of years, which shows exactly how competitive it is both here domestically and overseas. Others have said that they're pulling back a little from the sector because there's a lot of flows going into the area. So, for example, Australian Retirement Trust, the second largest pension fund in Australia, has said that it's been allocating quite a lot over the last few years. It's now looking to focus potentially more on real assets going forward. But others, such as QIC, albeit having a lower base of private credit, about Australian $1.5 billion, they're looking to double that allocation in the next 2 to 3 years. IFM Investors is another one we've spoken to in the past week who've seen enormous growth in their allocations and they're continuing to enjoy strong returns. Those two investors are targeting returns of somewhere in the range of 9 to 11% when they're looking at these deals.
So we know regulators are interested in this area of the market. What are they saying?
That's right, Paul. It's been at least 12 months since the regulators, APRA and ASIC, the dual regulator system here for pension funds and institutional investors, have said that they've been stepping up their focus on private markets more broadly. But we know from speaking to ASIC Commissioner Simone Constant earlier this month, she has raised questions about why banks would pull back from a sector and why super funds would be prepared to take on some of that risk. Suffice to say that they are taking a very close look at valuations and activity in this sector, and we know that ASIC has set up a private markets squad, if you like, to monitor valuations here as well.
All right, Australian pensions reporter Amy Bainbridge there in Melbourne. Tech and e-commerce firm Prosus says it's betting big on investments in China and India as it seeks to double its value within the next 5 years. Fabrizio Belosi became CEO of Prosus and its parent Naspers in July. He told us exclusively about plans to put AI at the core of their business strategy.
We are in a moment of big transformation. The whole world is going to transform completely over the next few years. We have new technologies like artificial intelligence that are going to be distributed to countries all around the world. We are positioned in many countries outside the US that put us in a very special position to distribute these new services through our e-commerce operations around the world.
Yes, and thinking about your global business, clearly you have exposure to China through your Tencent holding, but you've recently cut that back a little bit. You've also taken action on Trip.com. I wonder what is driving your thinking about China at the moment. Are you concerned about geopolitics, concerned about the Chinese consumer, or is it something else?
We are very excited about the China opportunity. China is the biggest internet market in the world, and Tencent, that we are the biggest shareholder, is one of the best operations in internet in the world. However, my goal is also to make Prosus a more balanced company. Our goal is to make the rest of the portfolio as big as our participation in Tencent. So I have to keep investing not only in China, but in India, and we have great success in many of our investments in India, and we are very excited about what's happening in India right now. And also keep investing in Latin America, where we have iFood and Delivery Hero in Latin America. So we have many other regions to keep investing. That's why we are diversifying a little more our positions.
So that's China, that's India, that's plenty of other emerging markets. Yes. What about the roots of the company way back, more than 100 years ago in South Africa? I mean, clearly you still have some newspaper assets there, but are there things that excite you, areas of growth that you foresee for South Africa?
We have a nice position in South Africa, for example, in e-commerce, where we have Take-A-Lot in South Africa. We also have many classified business in South Africa and some news business in South Africa. So we expected to keep being the most important internet company in South Africa and keep investing in Africa, in Eastern and Central Europe. I think that's the opportunity for Prosus. We are a big tech with 30,000 people and a capability to invest billions of dollars that can invest in Africa, in Europe, in Latin America, and in India. And I think having this flexibility to invest in all these regions is every time more a requirement for the world. Today we have so much investment in Latin America and in China, but with this transition to artificial intelligence, it's important to invest all around the world to develop local capabilities and local companies, and to develop and to fulfill the local needs that need to be fulfilled through this new technology, and that's what we are going to do.
Prosus and Asper CEO Fabrizio Blasi, they're speaking exclusively with Bloomberg's Anna Edwards. Another big conversation coming up today. ASML President and CEO Christophe Fouquet speaks at the Bloomberg Tech event in London. Our coverage will be live here on Bloomberg TV or on Bloomberg.com. The market opens are next. This is Bloomberg.
This is the Asia trade. We're counting down to Asia's major market opens, just about 40 seconds away from the open in Korea and Japan, Heidi. And it does feel like we're struggling perhaps a little bit for some sort of catalyst, some conviction today. Not a lot of data, although we had heard from some Fed speakers, and the overarching theme seems to be steady as she goes.
Steady as she goes, and certainly there's no indication perhaps of, certainly an admittance of any sort of policy mistake, right? But that is very much one of the biggest thematics that we still consider to be driving these markets. And interesting, we're getting some, a little bit of a moderation of these calls from the likes of Goldman's, for example, in terms of how much further upside we can expect to see in US equities.
Yeah, and Apollo's Torsten Slock as well saying, well, look, the odds of the Fed doing nothing in November are rising as well. The US economy just powering ahead. Okay, well, here we are at the market open in Korea and Japan. And following on from the rather tepid day we saw on the Nikkei yesterday, we're off to a rather tepid start as well. Not a lot of movement there on the Nikkei. The Topix a little bit softer by about 1/5%. That very, very weak yen also continues to be a theme. 150, weaker than that at the moment in Japan. The yield on the 10-year just creeping up a little bit. We'll get to yields in just a moment. If we take a look at what's happening in Korea as well, we've got the Kospi off right now by about 0.1%. We did see some modest gains in South Korea yesterday, but we'll be keeping an eye as usual on some of those tech stocks. We did see a reasonable performance on the Nasdaq in the US, but most of those major markets a little bit softer, Heidi.
Yeah, we are seeing that extension of the sell-off when it comes to Australian and New Zealand bonds as well, following that global trend as we continue to watch for some of the communications from the the Fed. Also watching oil, we're seeing kind of a steadying, although a little bit of a pullback perhaps after the 2% that we saw put on in the previous session on Monday. This is a market that dropped 8% last week as these geopolitical tensions continue to be finely balanced when it comes to potential upside risk from more easing from China as well. But Paul, you mentioned what we heard from the Fed, and Mary Daly of the San Francisco Fed was one of those speakers, and it was quite interesting to hear what she had to say in terms of the trajectory going forward for the Fed in this cutting cycle. Take a listen.
So far, I haven't seen any information that would suggest we wouldn't continue to reduce the interest rate. This is a very tight interest rate for an economy that already is on a path to 2% inflation, and I don't want to see the labor market slow further.
Garfield Reynolds leads our Markets Live Asia coverage and joins us now. So Garth, we're hearing more and more from the Fed, mostly consistent, although, quite cautious.
Yeah, yes, consistently cautious, with even a leavening. Schmidt was the one who sounded the most like they see the potential for not cutting rates at every meeting going forward, and that helps to explain why that rates traders keep on paring back their expectations for the Fed. I mean, they still see the sort of the consensus call looking at the swaps market is that the Fed will cut by 25 basis points in November and December. It's just there's about a 30% chance now that they don't cut at one of those meetings. And that compares with just 2 or 3 weeks ago, we had traders absolutely certain that the Fed would cut at both meetings, with one of those being a 50 basis point cut. So that's a big shift in a short amount of time. No wonder treasuries have sold off, no wonder yields are climbing.
What's underpinning that shift? What are some of the catalysts? And I mean, obviously, suspect number one would have to be the upcoming US election, but what else is causing some of this reevaluation?
Well, I would actually say that's about number 3 in the lineup, perhaps the most recent one. But the most important thing has been the way that the economy has defied expectations for it to crack. In the face of what's still a very high, as Daly was saying, still a very high rate. But you look at the discount that 2-year treasuries offer to the cash rate is at about 100 basis points now. It was 200 basis points quite recently. Those are the sort of levels you usually see just as a recession is hitting. Now, you look around what the US economy is doing now, it might be showing some pockets of weakness, but there's no recession here. So that's number one. Number two is supply concerns that over the coming months, once the US election is out of the way, whichever side of politics wins, or even if neither side wins, as it were, if we get a divided Congress, you're not going to get a step down in the spending profile. You're going to keep on getting more and more issuance. That's a problem that's been building for a while, and it continues to build. Meanwhile, then the third one is, the US election is coming. That creates uncertainty, including about the spending outlook. And in particular, there's been a noticeable extra tick up in yields over the last couple of days as you had betting markets turning more and more towards the idea that Trump will win election. If he wins election, whether or not he gets Congress on his side, he said he will boost tariffs. Boosting tariffs is seen as inflationary, so that's bad for bonds.
How does that put further pressure on Asian currencies, particularly Japan? Arguably the yen at the moment is sort of confounding its own issues.
Yes, well, the yen's at the sharp point of this spear right here. It's been very sensitive to US yields for most of the last couple of years for all of the obvious reasons to do with policy divergence. That's been exacerbated just now by what's going on with Japan's own politics. They've got an election coming up. The struggles of the LDPR are seen as making it much harder for the BOJ to move aggressively on hiking rates again. So there's the idea that the BOJ is going to wait at least until after the election to even signal what it might do, and quite possibly that it will wait until next year. So if it's going to keep on waiting on hiking rates, the Fed is seen as less active in cutting rates. That policy divergence puts pressure on the yen. But the pressure is on all the currencies out there. The US dollar rose against every major peer overnight, every major developed peer overnight, just rose by more against the yen. I mean, the second biggest decliner against the dollar overnight was the Australian dollar. And the RBA has made it clear it's not even thinking about rate cuts. So it's not just about that policy divergence picture, as it were. What it's really about is about what's going on with US yields and the yield divergence. That's what's driving the dollar higher.
All right, Garfield Reynolds, who leads our Market Live Asia coverage. All right, do stay with us. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at what we're watching when it comes to some of the energy and mining related names, I should say, trading in Australia at the moment. Woodside Energy seeing a little bit of downside there. Broadly, we are seeing a little bit of pressure there, particularly when it comes to the iron ore miners. Rio Tinto off by over 1%. Some of these concerns over the effectiveness of the China stimulus program and the transmission effect there, but also, of course, watching for the moves across energy markets. We did see about a 2% surge in crude prices yesterday, but coming off some of that recovery today. Well, Singapore's International Energy Week is underway, with the sustainability of the energy transition a key theme for this gathering. Our next guest is one of the speakers and runs Australia's largest LNG exporter. Joining us now is Meg O'Neill, who's a CEO and Managing Director at Woodside Energy. Meg, always a pleasure to speak to you, and this time from Singapore. You've been there for a couple of days now. Give us some insights into sort of what the energy and the levels of confidence and demand has been.
Yeah, thanks, Heidi, and it's a pleasure to be back on the program. It's been really a fascinating couple of days so far at Singapore International Energy Week. One of the things that's really impressive about this event is the fact that it convenes leaders from not just Southeast Asia, but from all around the world. And we heard a number of ministers speak yesterday about how each of their nations is grappling with the dual dilemma of ensuring that their citizens have adequate energy, as well as tackling climate change and meeting their respective NDCs. What I think is really interesting and a key takeaway for me is that every nation is going on this journey on their own place, and everybody's coming from a different starting place. There was a lot of conversation as well about regional collaboration, particularly here in Southeast Asia, where you've got nations in Southeast Asia, some of whom have great renewable potential, some of whom have great demand, some of whom have great financing capability. And so the obvious question is, how do you match all those things together to enable investment in low carbon energy forms to meet demand, to support the growth needs of those more developing economies? Some really interesting conversations.
A lot of those conversations, as you say, around energy security, and we have seen LNG prices come off the highs of a couple of years ago. I do wonder, do you see the sort of reignition of some of that insecurity? Does that mean that we could see more of a revival for prices?
Well, LNG prices right now actually are very strong. So we're in October, we're heading into winter in the Northern Hemisphere. Where prices are today actually is a little bit unusually high for this time of year. And the message that's telling me is that buyers are really worried about the potential for a very cold winter. So Europe has lucked out really since 2022. There's been 2 very mild winters. And I think buyers, particularly the Asian buyers who have that long-term orientation, are wanting to make sure that they have good gas inventories ahead of the commencement of winter to ensure that there's not any risk of power disruptions to their citizens and their businesses. So I think in the short term, the market is very finely balanced. Obviously, in the longer term, there's more supply coming in. But one of the things I took away from the conference yesterday was the fact that demand for LNG in particular will continue to grow as the Asian nations, particularly Southeast Asian nations, continue to economically develop, and they need critical energy like LNG to meet the energy needs to underpin that economic growth.
In terms of some of the country-specific demand that we've been hearing about, Bloomberg was reporting on some of the comments of a Japanese government official where you are there in Singapore yesterday, talking about demand increasing in Japan. Are you seeing more Japanese interest in buying some of Woodside's products?
Yeah, it's really interesting, actually. So over the past year, we've brought 2 Japanese companies in to partner in our Scarborough Energy Project, which is a new LNG development in the northwest of Australia. So LNG Japan, which is a joint venture between Sumitomo and Sojitz, and JERA, who is Japan's leading utility, have both taken equity positions in the project, so they're going to be able to lift their own LNG. But in addition to their equity positions, they've both agreed to take more LNG offtake. And I'm very pleased that we've firmed that contract up with JERA, so a 10-year contract starting in 2026. So it's very clear to me that Japan, and particularly a lot of the leading Japanese companies, are taking steps to ensure their long-term energy needs are met, particularly as the nation starts to grapple with this idea of increasing energy demand associated with chips manufacturing and the growth of AI and data centers.
What's happening on the supply side as well? Because we've seen a number of LNG projects in the United States, for example, becoming delayed due to inflation, a shortage of workers, familiar sort of story, really. What's Woodside doing to avoid this kind of issue? And I'm thinking specifically about the Louisiana LNG project.
Yeah, one of the things that really appealed to us about Tellurian and the Louisiana LNG project is the fact that we have all of the permits required up to the full development potential. So the 27.6 million tons per annum of LNG capacity is fully permitted. The second thing that's really appealing, and particularly in the context of the inflationary pressures, is we have a design that's been all the way through FEED. We have Bechtel locked in as the prime contractor for the work. Construction at the site has been underway for 2 years, actually. It's been very much focused on the civils, but when you look at where LNG projects typically encounter cost and schedule pressures, it's in the civils. So we've de-risked that element of the project. Now we're working very closely with Bechtel to finalize the terms of the engineering, procurement, and construction contract. We expect to have the contract pricing locked in within the next month or so. So for us, it's actually all systems go to be ready to take that final investment decision in the first quarter of next year.
Meg, I wanted to ask about this liquid hydrogen deal with Keppel that was announced just yesterday, I believe. Do you see this as sort of the first to kick off many such deals, or is it more of an interest gauging exercise?
No, this is a genuine term sheet. So we signed an MOU with Keppel back in 2023, and what we announced yesterday is that we've come to a term sheet on what exactly the offtake of liquid hydrogen might look like between Woodside as a seller and Keppel as a buyer. And the agreement, we've been doing a lot of technical work to understand what's required to set up a liquid hydrogen value chain. We understand what's required to produce liquid hydrogen. It's actually a lot like liquid natural gas. It's a bit colder, minus 253 C versus minus 170 C. So it is a colder gas, but the basic process of gas liquefaction is one we know extremely well. We've been doing work in the shipping space to understand what's required to be able to ship this product. I'm very pleased that we've recently obtained maritime certification for a ship that we've been working to design. So there's a lot of substance to the agreement that we've signed with Keppel. Now it is a conditional agreement. There are a few steps that we have to go through and Keppel has to go through. But it's a great step forward in this journey towards lower carbon molecules being used to support the energy needs of a mature and developed economy like Singapore.
What are the sort of expenses associated with shipping liquid hydrogen compared to, say, LNG? Is there a premium associated there, at least in the short term?
So at this point in time, there's one ship on the water that's capable of shipping liquid hydrogen. It's small scale, so it wouldn't be suitable for the kind of industrial value chain that we're envisioning with the Keppel agreement. But we've been, as I said, doing quite a bit of work with one of the Korean ship designers on how exactly do you design a larger ship for hydrogen transport, and working through with the certification agencies to get their stamp of approval on the design. So it's probably a little bit too early to comment on costs versus LNG. And I think what's important actually is to look at the total value chain cost. So from supply all the way through to delivery and then to the customer at the end point. Look, it's not going to surprise anyone that the cost of liquid hydrogen is going to be more than the cost of conventional fuels. And that was clearly a theme in the discussions yesterday, was again around how nations around the world are going to grapple with this question of ensuring reliable energy, working towards decarbonization, but also keeping energy affordable and bringing citizens along on the journey. The liquid hydrogen agreement with Keppel, I think, is a great example of a step on that journey. And it's in the context of Singapore's data center decarbonization roadmap, which lays out their vision for how to build out a data center industry whilst not impacting the emissions of the nation.
Meg, just finally on hydrogen, you've outlined a number of the challenges there. How well understood do you feel they are by the market? Because it's a small molecule, it's hard to control, it leaks, it's expensive to transport. Do you feel that perhaps hydrogen might be better suited as an in situ energy source?
Yeah, certainly a few years ago I would have said the hydrogen hype was well ahead of the hydrogen reality. I think more people today are understanding the complexities of what's going to be required to develop a hydrogen value chain. I think the other thing that's become important is there's maybe a little bit less rhetoric around the color of hydrogen, and a better understanding that for the world to build a hydrogen industry, we're actually going to have to be color agnostic. So the projects that we're looking at, particularly in Australia, we're looking at using gas as a feedstock to produce hydrogen, and then using carbon capture and sequestration to deal with the CO2 that's emitted. That's a much lower cost than trying to pursue a hydrogen process that is purely based on renewables as input. So I think there is a bit more reality coming to the hydrogen conversation. I think there's a better recognition that there are certain sectors that are well suited to using this kind of molecule. And there are other sectors that are just going to take a bit more time, and maybe different solutions will be the best answer. But for things like data centers, and again, particularly in the context of Singapore, where you've got the ability to aggregate energy supply and meet those new sources of energy demand, such as data centers, I think this is a great sign that liquid hydrogen is certainly a strong candidate to help meet that energy need.
Meg, I think the last time we conversed, we talked a bit about driftwood, and we're now just 2 weeks away from the US presidential election. I do wonder what sort of risks are you sort of looking at in terms of associated with an uncertain outcome from that? And also, does that mean you're sort of pulling back on M&A and looking at deals until the political landscape is a little bit more settled?
Yeah, well, we've actually just done two big deals. So in addition to the acquisition of Tellurian and what we've now renamed Louisiana LNG, we also recently acquired a blue ammonia project in Beaumont, Texas, so also in the US, that uses CCS to sequester the CO2 that's produced in the manufacturing of hydrogen. So both of those transactions have closed. At this point, our focus is very much on ensuring that we deliver the value our shareholders expect from these two transactions as opposed to new M&A. But if I loop back to your question around the election, I think it's worth noting, if you look at the facts, oil and gas production grew more under Biden than it did under Trump. So the oil and gas industry in the U.S. is very resilient, and whilst there's a strong focus from the Biden administration on decarbonization and tackling things like methane emissions and CO2 emissions, there's also a recognition that domestic energy production is good for U.S. energy security. So we feel pretty well positioned, actually, regardless of who wins the election, that the opportunities we have in both the clean ammonia project in Texas and the Louisiana LNG opportunity on the Gulf Coast as well, that both of those opportunities will be able to thrive under whoever's in charge of the U.S. in a few weeks' time.
Meg, really great to chat with you as always. Meg O'Neill, CEO at Woodside Energy. Well, Bank of America Chairman and CEO Brian Moynihan is headed to Sydney to mark 60 years since the opening of its first Australian office, and he will be joining us exclusively tomorrow. That conversation at 8 a.m. Hong Kong, or 8 p.m. if you're watching in New York. More ahead, this is Bloomberg. US officials are in the Middle East in an attempt to engineer a ceasefire between Israel and Iran-backed Hezbollah and Hamas. Bloomberg's Michael Heath joins us now. And Antony Blinken, you know, this is a path well trodden for him at this point.
Yeah, he's been here a number of times before, 11 in fact. This is his 11th visit since Hamas's attack on October the 7th. So it's really, it's sort of almost a last opportunity, it feels like. You know, we're 2 weeks out from an election. And Israel is obviously on the front foot in terms of what it's been able to achieve against Hezbollah and against Hamas too, with the deaths of the senior officials there. And it's sort of hard to see why Israel would stop, particularly in the case of Lebanon now, where it has this unique opportunity to try and degrade Hezbollah, given there's no real Lebanese state that can control it or rein it in. But then the other issue, of course, is this retaliation against Iran that sort of everyone's been waiting on. There are reports that the US anti-missile defence, which had sort of been waited on, is sort of now up and running. So we're all just sort of waiting to see what happens there.
Is there any interest from the Israeli side to pursue a ceasefire? Is it really in Benjamin Netanyahu's interest to do so?
It's hard to see what the advantage is for him at this stage, Paul, because we know that he's got some legal issues as well, and his this right-wing cabinet he has and he depends on them to have a strong majority. They want to keep pushing into the end kind of thing, and they're even talking about resettling Gaza and these sorts of things. But particularly when it comes to Lebanon, they want to get these people who've had to leave there, to get out of the way of Hezbollah's missiles. They want to get them back in place, and they want Hezbollah back behind the Litani River there. So, yeah, I mean, until they get some certainty on that, I think that Israel's not going to be too keen.
All right, Bloomberg's Michael Heath there. Do stay with us. We have more ahead on the Asia trade. This is Bloomberg. Right, let's see how we're tracking on Asia markets. Not particularly well. Bit of a down day at the moment. Quite a bit of selling here in Australia. The ASX off by 1.1%. A lot of the materials stocks are weaker as well. The gold miners had a great day yesterday. Not so much today. Gold giving up some of its gains. We've got the Nikkei doing the best of the bunch, really. It was a flat day yesterday in Japan, and it's looking kind of flat again today. The Kospi off there by about 0.5%. If we take a quick look at the oil price, that's fairly stable as well, 74.09 at the moment for a barrel of Brent. A few competing catalysts here. Middle East tension obviously continuing to simmer, and a bit of uncertainty as well around the demand outlook, particularly in terms of China, although we did see that larger than expected cut by the banks to both the 1- and 5-year loan prime rates yesterday. Well, the Indian unit of Hyundai Motor makes its trading debut in a few hours. The $3.3 billion listing set to be India's biggest IPO ever. Bloomberg intelligence analyst Joanna Chen joins us now. So, Joanna, how's Hyundai Motor India valued against its local peers and the Korean parent as well? Do you think it's priced on the rich side or not?
Yeah, hi. Exciting, right? India's largest ever IPO and with Hyundai Motor India. And we all saw that India's stock market had a really robust run in the past few years, and with that growth optimism, Indian companies in general have higher valuation versus their global peers. And actually, Hyundai Motor India is no exception. We calculate that based on the IPO price, Hyundai Motor India's price implies more than 20 times its fiscal 2025 earnings ending March. That's actually close to the average multiple of its other Indian automakers like Maruti Suzuki, Tata Motors, and also Mahindra. But if you look at the parent South Korea's Hyundai Motor Company, it's trading at only 4.2, 4.3 times forward earnings. So from that perspective, we do see a huge India premium factoring in this IPO price.
The proceeds will go entirely to the Korean parent. Do we know about deployment of those funds? What's the implication for investors?
Yes, indeed. All of the $3 billion proceeds will go into the South Korean parent. We're still waiting for management's official comments on how are they going to use those proceeds, which could be a large focus in Hyundai's third quarter earnings call coming later this week. But, back in August, at Hyundai's 2024 Investor Day, the company put a lot of emphasis on its plan to boost shareholder returns, including dividends and also buybacks, and also to increase long-term investments, particularly in electrification, autonomous driving, this kind of areas, to secure its long-term competitiveness in the auto industry. So we are also thinking that the $3 billion proceeds could swing to that direction. And definitely with this cash boost, the investors could have greater visibility on Hyundai's abilities to execute and also deliver on those long-term strategies.
So how important is the India business going to be to Hyundai? What's the future growth plan?
Yes, so the India unit actually is Hyundai's largest production base outside its home market, South Korea, and it contributes about 20% of Hyundai's global production. And we actually see that India could be one of Hyundai's major growth priority in Asia for two reasons. First, it is a rather lucrative local market. 4 million passenger vehicles sold in India last year, and the auto penetration is still low with the growing economies and also middle class. We do see demand going higher over the long term. And also the second reason is that India could emerge as a global manufacturing hub because of the low cost and also balancing the risk of overdependence on China manufacturing and supply chains. So with that, Hyundai will be introducing more new models in India, particularly SUVs, to defend its market share. And also there will be more capacity. Hyundai just acquired a former General Motors plant last year, and now the plant will be is expected to go online by late 2025. With that, when that plant goes to full operation, that will boost Hyundai's capacity in India by 30% to over 1 million cars per year. So we do see Hyundai keep investing in the India business, and with that, we do see the long-term growth potential.
All right, Bloomberg intelligence analyst Joanna Chen there. And you can turn to your Bloomberg for more on Hyundai's India trading debut. You can go to TLive Go, that's TLIV Go, on your terminal to get commentary and analysis from Bloomberg's expert editors. Let's get to the latest now on the corporate front. Cheesecake Factory shares jumping after the bell on a report that activist investor JCP has reportedly built a 2% stake. The Wall Street Journal says JCP is urging executives to spin off 3 of the firm's smaller restaurant brands into a separate public company. Bloomberg Intelligence thinks Cheesecake Factory might push back against that plan due to cost duplications.
Disney has named James Gorman as chairman and says it will also appoint a new CEO in early 2026. Gorman is, of course, a former CEO of Morgan Stanley and was tapped in August to head Disney's succession planning. Bob Iger returned to the top job in 2022 after the ouster of his successor, Bob Chapek. Iger says he will leave for good, this time when his contract expires.
Qualcomm has unveiled a more powerful processor that's designed to bring laptop-level capabilities to smartphones. The shift in design is expected to help mobile mobile devices take advantage of new AI tools. Qualcomm says the new chip will be 45% faster than the previous model and it'll use less energy.
Well, Paul, it's been almost a month since China signalled its intent for supercharged stimulus, and many investors have been disappointed by a lack of concrete details. A Bloomberg opinion columnist Shuli joins us now to talk through her latest column, and within it you say that investors simply need to be patient. Of course, a lot of them are screaming for the fiscal side to be announced. Do you think we'll see that $1 trillion stimulus coming out, and in what form of patience do these investors need to have?
I think we should not expect the concrete numbers to come out anytime, perhaps before early next year, because this round of stimulus is going to be very different from what we had in 2008 or 2015. The focus of this stimulus is basically debt restructuring. We know one reason why China's economy is not doing so well is because of fiscal austerity. Local governments no longer have money and are so indebted that they cannot boost the regional economies anymore. So that's one thing that the government said they would do. Another thing is to recapitalize the big banks and then make sure that they have enough capital so that they can lend. They can lend to distressed developers so that these developers can finish the pre-sold homes. And all these things take time because, first of all, to come up with a final number, you need to know how much debt there is on local government's books or off their books, and how much that could go bad with the big banks' books. So we have to start with a rough audit first, and then we can come up with how much debt, right? And then we can say, okay, how much stimulus is needed. It's very different from 2008. 2008 is basically you do infrastructure spending and you throw a bunch of construction jobs at the migrant workers. Or 2015, the Shantytown redevelopment. Back then, the Chinese government basically tore down old buildings and paid villagers a bunch of money so that they could go spend. This time, that restructuring is very, very different.
So how about the implications for investors then? Because we've got US equity gains possibly slowing. How should investors position in China at this point?
I don't think it's a good place for momentum chasers because China's stock market can move very quickly, as we have seen. It's not like it's very sleepy and suddenly it can just move up 10, 15% a day. And I think for investors who really are interested in China, they have to take the stance of a distressed debt specialist. And as the likes of Oaktree, all these distressed debt players, they know restructuring takes time. I mean, we are looking at Evergrande. Evergrande has defaulted 3 years ago, right? And then the restructuring is not even working. So it's moving along very, very slowly. And the Chinese government has a lot more problems, and it's going to take time.
Bloomberg opinion columnist Shuli there. Well, BRICS members are gathering in the Russian city of Kazan for their first meeting since the group expanded in January. But much of the focus is on the relationship between China and India as tensions over a border dispute ease. Bloomberg's news desk editor Jill Desis joins us now for more. So what are we watching in terms of this potentially thawing of what has been, a very difficult relationship?
Yes, that's right, Heidi. So this kind of feels like it's been a long time coming, but at this point, it does seem like we're potentially paving the way for a meeting between President Xi and President Modi and Prime Minister Modi at this BRICS meeting in Russia. So essentially, leading up to this point, we've seen some more incremental meetings between the Chinese and between India. The latest that we have is that they've actually agreed to ease some of this this tension over the India-China border just ahead of this meeting. They've allowed sort of border patrols to continue operating there from both countries. This is significant given that 4 years ago, as a lot of these border tensions were really flaring up, that's what really led to a chilling effect happening between the relations between these two countries. We saw India, for example, put a lot of restrictions on Chinese businesses. Now, again, ahead of this BRICS meeting in Russia, it does seem like maybe there's some potential for leaders of both of these countries to actually meet up and talk things through even further.
It's interesting, though, isn't it? Because there we have India, a member of the Quad, along with the US, Japan and Australia, meeting the leader of China in Russia. What are the optics of this? How do we interpret this, particularly from a US perspective?
Well, I think, I mean, if you're the U.S. and you're seeing that Putin is hosting BRICS this year, it does indicate that, obviously, in the aftermath of the last few years, after Russia's war in Ukraine broke out, Putin and Russia are really kind of fighting back here and saying, look, like we still kind of belong on the world stage. You haven't successfully shunned every single nation from wanting to, come and work with us and develop relationships with us. So I think what we're seeing out of this BRICS meeting here happening in Russia, because you do have the leaders of China, India, you have Brazil, obviously a BRICS participant, although Lula isn't actually attending in person, but you do have a lot of global interest in this setup that Russia is obviously one of the spearheaders of. You've got some new members of BRICS coming in. It does kind of show from Putin's perspective that yes, he's trying to tell the U.S. that on the world stage you can't completely isolate Russia.
All right, Bloomberg News Desk Editor Jill Desis there. More ahead on the Asia trade. This is Bloomberg.
Well, King Charles is on his first trip to Australia since being crowned in 2023. The British monarch remains Australia's head of state 25 years after a referendum on constitutional change was defeated. Indigenous Senator Lydia Thorpe interrupted a royal reception at Parliament House in Canberra on Monday, calling for a treaty between the Australian government and First Nations people. Let's bring now Esther Anatolitis, who's a co-chair of the Australian Republican Movement. Esther, great to have you with us. And let me begin by asking, with this visit, what have you seen in terms of public sentiment, the interest in going again for this Republic debate?
Well, we're seeing growing interest in the future Australian Republic and support for the future Australian Republic, which is not surprising when we have a visit by their sitting head of state only once every 10 or more years. It's been 11 years in this instance. It's a really important reminder for people that, yes, in this day and age, Australia's head of state is still a monarch from another country and not someone who is democratically selected by Australians. In fact, it's been the most frequent question in the global media interviews that my co-chair Nathan Hansford and I have been doing, which is that question of, oh gosh, I hadn't realised, like really in 2024 your head of state is in another country. We're of course in the minority of Commonwealth nations who aren't a republic yet, so it's I think at best a cause for sort of confusion and bemusement, and of course an important moment to keep thinking about and working towards the future Australian Republic.
I think that, it's interesting you talk about if it's mere sort of bemusement and a little bit of a throwback and a passing thought, if you will, what can kind of drive momentum for turning this into an actual issue that Australians will care about and will be decisive about, I guess, if there is still an enduring sort of background affection for the monarchy in Australia?
I think it's really about who we are as Australians today. So Australia is a richly diverse country. More than half of us now either were born overseas or have one parent who was born overseas. That includes me. I'm from a migrant family and English is not my first language. When we look at that history, as you say, Australia no longer has a privileged relationship with any one country around the world. And so what may have made sense in the past part at the time of federation very much no longer makes sense for Australia. Our campaign, which has been a popular culture campaign called Monarchy, the Farewell Oz Tour, has been all about really drawing out who we are as Australians. You know, we value fairness, we value equity, we value a fair go. But when we have these rare royal visits, they are, you know, a bit of a touring show that that democracy, you know, goes on a bit of a pause for as we focus on our visiting head of state, instead of having visiting dignitaries greeted by an Australian head of state who works for us full time, who is accountable only to us.
Esther, certainly the symbolism around this is very well understood, and it is a bit weird having a head of state that's on the other side of the planet and is a monarch as well. But Australians also have a love of pragmatism. This is cheap and it works just fine. Why change it?
I think Australians increasingly expect a head of state who is focused just on us full time, who is able to, in Australia and around the world, be a great unifying symbol, but who is also very rigorously focused and foresightful for Australia's interests, be they trade, cultural, or all those other interests domestically and internationally. A part-time head of state can't achieve that. Their focus is on numerous countries as well as their own kingdom. And of course it goes to the democratic focus, the democratic purpose. It doesn't make sense to have at the apex of Australian democracy a person who is not democratically selected by Australians, isn't an Australian citizen, and whose powers remain ill-defined in the Constitution, which of course doesn't mention our own Prime Minister. So there's a lot to work on there, legally, constitutionally, but also culturally and in terms of the ethics and the equity of democracy.
Well, as Heidi mentioned, there was a referendum on this 25 years ago, and it did famously fail, and Australia ended up keeping the monarchy. But part of the problem there was the debate around what replaces it, and the idea of electing a president or a head of state, and things became horribly politically embroiled. How do you answer this question going forward?
Well, of course, we are very much a different country to a generation ago. We're far more diverse than we were. And so that notion of that lack of a privileged relationship with another country, it's even more prominent now. The Australian Republic movement has developed a model called the Australian Choice Model, which was developed as a result of really extensive national consultation and input from constitutional scholars, which, you know, provides a balance between some of the great and practical models around the world, as well as being an evolution on our current model. And that's on our website, but really as a discussion starter, because the next step is really, of course, to continue our conversation so that that momentum does grow. And we know from Australian Republic movement research that 92% of Australians are open to the idea of the future Australian Republic, and 75% of currently serving federal MPs are also supportive. And so it's simply about maintaining those great conversations until we find the best moment for everyone.
Is that moment sooner rather than later? Because in a longer term, is it going to be difficult to maintain that momentum and to have that conviction? Because we know that the Prince and Princess of Wales are extremely popular.
Yes, and I'm heartened by that and the popularity of all the royals. But of course, Australian democracy isn't a show. We look at the people that we appoint on their merits, and we expect to elect our future head of state on that basis. It's the time, of course, will need to be right for everyone, and that's a conversation that does keep going. We've had, I think it was just a couple of years ago, when Prince William was in the Caribbean and was saying to nations, you know, becoming republics, that of course relationships evolve, but friendships endure, and that's it's a very simple and heartfelt and heartening approach of that evolution of the relationship and the friendship that awaits Australia.
All right, Esther Anatolitis, co-chair at the Australian Republican Movement. Thanks so much for joining us. And we have plenty more on Australia ahead every Tuesday, 10:40 a.m. if you're watching in Sydney, and that's 7:40 a.m. in Hong Kong. Heidi.
Tune into Bloomberg Australia, the podcast as well, which delves into the biggest stories shaping the country's role in global business. You can find that on Apple, on Spotify, on Bloomberg.com, or wherever you get your favourite podcasts. More ahead on the Asia trade. This is Bloomberg.
For me, to move quicker on the dots would be if we saw a weakening, like real evidence that the labor market is weakening quickly, then that would tell me, as one policymaker, hey, maybe we ought to bring down our interest rate more quickly than I currently expect. Right now, I forecasted some more modest cuts over the next several quarters to get to something around neutral, but it's going to depend on the data.
That's Minneapolis Fed President Neil Kashkari there. Let's get to some more market calls that we're following today. Goldman Sachs strategists say the decade of outsized gains on the S&P 500 is over. They say the Wall Street stocks benchmark will likely now trail Treasury bonds and even potentially lag behind inflation. Goldman expects an annualized nominal return of just over 3% over the coming 10 years, and that compares with 13% in the past decade and a long-term average of 11%.
For the Fed, Apollo believes chances of a hold in November are rising as the US economy continues to power ahead. Their chief economist, Torsten Slok, says he sees plenty of reasons for that strength and notes that the bottom line is that the expansion continues. He sees the US remaining on a no landing trajectory. The economy keeps growing, inflation reignites. Swaps markets at this point pricing less than a 25 basis point cut for November. Our markets coverage continues with Greater China opening in the next hour. This is Bloomberg.